back. I'm your host, Barry Waxler, here with the always lovely and talented Andrea Kay. I think we need to go down to the county courthouse and change your name. You know that?
Yeah?
You know, just like Lloyd Free from basketball changed his name to World Be Free, and a couple of the other
Meta
basketball
World
players.
Peace or whatever. Yeah,
Meta World Peace. Now it's going to be the lovely and talented Andrea Kay.
I'm all for that. Let's trademark it, too.
Okay, and then we take Urban down there with you with the incredible Urban Miaris.
Mm-hmm.
Another legend in workings, huh?
Yeah.
Okay.
Oh, he's so bored.
I know. Please, he's so above it. And what's the nickname for our next guest here?
The nickname for our next guest. Well, he's had many nicknames. I'm not sure we can put him on air, but I've known.
Not enough of them are rated G, right?
Yeah. Welcome, Myles Hubers. Welcome, Myles.
Thank you.
Great. So I've known Myles for 25 years, give or take.
Yeah, so probably like 1988.
Yeah.
Ah.
And Myles is the cause of having a couple of our other prior guests on. So we had, you remember Deb Hubers? That's Myles' sister.
Yeah, very cool lady.
I always
Smart
forget
gal.
if she's older or younger, but that's for her.
That's kind of you guys' beeswax.
She looks younger.
Okay.
But she has a pharmacy anti-aging, so
yeah,
that's probably the reason why.
25 years
Deb,
though, you guys have
and we had, you remember Angela Brannon?
Yeah.
Okay, well, I'm going to start this interview off by telling the story, okay?
Okay.
Uh-oh. There's my nickname's
That's
coming.
right.
Yeah.
That's great. Your nickname's coming. So, no, Myles introduced me to Angela Brannon, I don't know, 15 or 20 years ago, or 15 years ago, whatever it was. And he teased me. He said, yeah, we're all going to get in the limo. And it was Myles and a couple other notable people in town. And they all got in the limo for a charity function with Angela and went up to the Playboy Mansion up in L.A.
Oh.
And I thought I was going with them. But did
You weren't
Myles
in the
bring
limo?
me? No.
We weren't very good friends then.
So that's the guy you
That's
talk
it.
about.
And I don't see a trace of remorse on his face over there
No,
either.
no.
You know what? We raised $500,000 for charity.
Sure, that's what it was about.
What always works well is the guys pay and the women are free.
Yeah. Oh.
Yeah,
Okay.
So we did raise $500,000. I think men are $1,200 and women were free
Okay.
for abused children.
Okay. Women were free. Okay.
Yeah.
Better than having to pay for women.
Well, you know
But
what?
that's a topic for another day.
That's a topic for another show. Okay. So anyway, well, Myles is.
Wait, before we move
yeah.
on from that, does Myles have any pictures or photos?
I
of
do.
that? Oh, you do?
Yes.
Okay.
I will show you later.
Okay,
after
good.
I sign a non-circumvention.
Yes. Yes, I had to have. I had to have Myles sign a non-disclosure agreement about me before we got on air, so because we just go back too far.
He already shredded it.
By the way, Barry did make it in a cab.
Oh, I bet he did.
Well, we're going to move on here.
Okay.
Yeah.
So, Myles, tell us a little bit about what you're doing.
Well, I've been in lending, residential and commercial home loans for, 25 plus years now. Done a little over $10 billion in loans and a little over 80,000 clients. And rates are drifting up just a little bit, but they're still below 4%. So people think they're crazy high. They're still below 4.
Okay.
Depending on how good your credit is. And so also lending is kind of loosened. So if you have equity and cash reserves, they don't ask for tax returns.
Okay. So we're back to a no tax return.
You know, I hate to say that because what happened, those stated income loans were no money down and no cash reserves. Now they're pretty conservative. We have to have at least 30% down, at least 6 months cash reserves.
Right. So, but at least they're out there. And, when you take a look, we just had Ron Samuel on ahead of you. And when you take a look at the tax perspectives, if you're employed by somebody else, you get a W-2, it's pretty easy to define what your income is and income assets and loan qualification. When you're self-employed, there's so many different, games you play on your tax return. It's hard to show what you really make. And what you're telling me now is the people that used to do stated income loans by the carload at least have, a cab full of people that can come in there and do it.
They're institutional portfolio lenders. They're not your common banks that sell the second. So they take risk as investors. But with a lot of equity and cash reserves, the foreclosure rates are very low.
Great.
So
That's a big problem that self-employed have had for as long as I can remember. It would be getting a home. It'd be qualifying for a mortgage because of self-employment.
Yeah.
It truly is. They can add back some of the write-offs like depreciation and things. That kind of makes sense. So as long as you have decent credit, at least 30% equity and adequate cash reserves.
Okay. What does decent credit mean? I mean, let's relate it to FICO score.
Well, I think the highest FICO would go is 850, but most banks' portfolio lenders want a 700 FICO, which is an A credit score.
Right.
For example, on a VA loan in California or FHA, you could go all the way down to 580.
Wow.
A 580 FICO with no money down for the veterans. And so no PMI either.
Oh, my goodness.
No PMI.
So if you could get a VA certification, that's the best loan you could ever find.
Great. Well, we need to talk because we have people like Eve who deals with nothing but veteran employment. So, and a lot of veterans know they're qualified for benefits, but they don't know what that means.
Right. Well, the best benefit probably is that mortgage. If they can get a VA certification, that's a wonderful deal with no money down and no private mortgage insurance.
Great. So interesting. So you have veteran loans available. Mm-hmm. You have standard loans. You have the jumbos. You have virtually everything you need. And the banking industry changed some years back with the crash of 2008.
Yeah, for the good.
Right.
Really, it's more conservative in your licensing, and people have to qualify. And there's no such thing as no money down. Unless you're backed by the government, like a VA loan.
Right.
FHAs are still only 3.5% down. The Federal Housing Administration is only 3.5% down with private mortgage insurance.
Interesting.
So yeah, it's gotten tighter, which it needed to be.
Good. You're listening to Close Up on San Diego Business here on KCBQ, streaming live at AM1170theanswer.com. Give us a tweet at CloseUpSD. Email me at barry@closeupsandiego.com or find our page on Facebook. We want to hear from you. I'm your host, Barry Waxler, here with Andrea Kay, Urban Miaris, and Myles Hubers. So now you're doing some things other than just mortgage lending, correct?
Yeah, you mean as an investor myself, or?
Well, we talked about it in the green room. Are you working with other people on things other than mortgages, or was that?
I've been flipping houses.
Okay.
I've been doing that for on the side probably for 15 years. I normally buy a non-performing note and then cure that note, and then I rent the property or flip it.
Great.
So.
Great.
I didn't know anybody was doing well flipping right now.
Well, I've been doing it for 10 years, and it's getting harder and harder to find them.
Yeah.
Because the prices have gone up so much. So it's getting hard because everybody's doing it. So I'm kind of stopping that, so to speak. But I've been doing it since actually 1999.
Which areas in San Diego are really the best for you right now with that?
Well, San Francisco is really good.
San Fran?
Yeah, there's so many jobs and income, and there's Facebook and Google and things like that where, I think the average price of a house might be $900,000, and they're pretty much gone the same day.
Wow.
They're harder to find.
Wow.
Yeah, and they have a designated corridor, I understand, in downtown San Francisco now is a high-density economic boom corridor, building 40-story high-rises around houses and everything now.
Right.
Yeah.
Well, my goal has always been to, there's periods that go up and periods that go down. Mm-hmm. You have to be able to hold through those.
Right.
So something that cash flows is key. Because in 2001, everybody made a ton of money.
Right.
And everybody lost all that money in 2007 and 2008.
Yeah.
But if you're able to, cover your debt service, that is kind of, I think instrumental. So if the payment's $3,000 and you're renting it for $3,000, you can hold on for a long time through that bubble.
Yeah. Well, speaking to real estate investors, the big thing back in 2001, 2003, 4, 5, whatever it was, you'd go out and you could get all these low money down, easy qualify loans, and you'd get all the property, but you had high interest rates. Okay. Interest rates down under 4, that helps you cash flow an awful lot.
Tremendous. We used to pay only cash, but with the rates so low, you might as well leverage a little bit.
Sure.
If you're borrowing money at 4% and it's tax deductible, it could be as low as 2%. That's cheap money.
Yeah.
So a lot of people like to put a little bit of leverage on their house if they can diversify their risk, put that money somewhere else, getting a higher rate of return. So if you're borrowing money at 2 and you could get 4 with a really safe investment, you're making money on your money, which is what a banker does. That's called a yield or arbitrage. And Barry's the king of arbitrage. In fact, he gave me this book, I think, how long ago, Barry?
I don't know. That had to be back in the 90s somewhere.
Yeah.
So Ordinary People, Extraordinary Wealth. So.
And you made a challenge to me on the phone. You want to tell everybody about that?
Well, I'm borrowing money at 3.25 is my mortgage, and it's tax deductible. So if I could get more than 3.25 and my money had less risk, why would I pay it off? Is my challenge to her. Mm-hmm. So I offered her a large sum of money if she could tell me one reason why to pay my house off. And I haven't heard one yet.
Because when people retire, they need to be debt-free.
What if you had more than your mortgage was owed, but your money's getting a higher rate of return? Why would you want to pay your mortgage off?
Well, because it depends on is that money liquid and available?
Well, Barry's a financial planner. So, Barry, can you get me more than 2.5%?
And make it be available to where I don't have to pay a fat chunk if I pull it out from wherever it's parked.
Here's the analogy that I'll give you. Okay? What would you rather have? $1 million tied up in equity in your home, okay, that is not going to grow because your home is going to appreciate at the same level whether it's in the home or it's not. You're going to appreciate the same way. So you have equity that will do absolutely zero growth, and that's a guarantee. Okay?
Mm-hmm.
Or would you rather have no equity in your home, but $1 million sitting in a safe conservative investment, thinking that, well, if everything turns upside down, okay, I can always go into my investment and pay off my home. Now you have money earning over here at whatever rate of return it's getting versus a guarantee of zero at best. Because what happens if you have equity in your home and the real estate market crashes again?
Mm-hmm.
Well, I think the key was diversification there.
Right.
For example, I don't have earthquake insurance.
Right.
I've sat in my backyard before, and I said, oh, boy.
Yeah.
I saw the waves crashing and things. And I said, if my 100% of my net worth was there, like a mudslide or a hurricane or something like that, I wish I was diversified. And I'm hoping my financial planner could get me more than 2% tax deferred with less risk.
Well, I would hope he would, but still my question is, the scenario I'm laying out is you're retired and you want to have no debt and you want to have all of your funds. You got to have a lot of liquid. You got in retirement. So it doesn't help me if I now have this fat note on my house and then my money is parked somewhere I can't access because to pull it out is going to cost me tax.
You just said the key word.
Yes.
Liquid.
Yeah.
Okay?
Is that before or after
liquidity.
taxes?
Yeah. You have no liquidity in your home. Okay? You have to borrow money to get out. What happens if you have $1 million in your home, you have nothing in savings, and I know that's an extreme. Okay, you have $1 million in your home, you have nothing in savings, and you have your mother, father, sister, brother comes down and gets in a car accident, needs all kinds of financial support, whatever it happens to be. What are you going to do? You're going to go out and go to
tell them to hit the road. Go elsewhere. Knock on somebody else's door.
Okay,
Carry on.
Remind me not to apply to be part of your family, okay?
I hear what you're saying.
Yeah.
So there's a lot of reasons, and there's a lot of ways you go back and forth. So
I think she was discussing what about cash flow?
Yes, cash flow is my main question.
Some of these investments you could receive dividends if you needed them.
Oh, okay.
Problem I find is, go ahead, Myles.
I was just going to say, you take $1 million, you put it at a 4% interest rate, you have a 2% loan, and I again know those aren't real numbers, but you have a 4% interest rate on the investment, a 2% loan on the home. You use 2 of your 4% to pay your mortgage. Okay?
That's becoming a banker, and that's called arbitrage or a yield. But I think it's more key to have less risk and diversify your portfolio.
Right.
So if your entire net worth was in your house, it'd be in one spot. So if you owned a $500,000 house in California, free and clear, and you owned nothing else, I don't think that's a very good symbol of diversification.
Gotcha.
Right. Today too many of us have the attitudes of our parents and our grandparents on investing financial because, I remember my grandparents, you had to pay off your home. That was their burn the mortgage.
And do you know why?
That's not true today.
Do you know why Do you know why they had that attitude?
What?
You go back to the Depression.
Yes.
Okay. Mm-hmm. And in the Depression, when everybody started taking their money out of the banks, there were no laws that said that the banks couldn't just foreclose on your home anytime they wanted. So the banks would come out and say, Urban, pay your home off or we're taking it. Okay? And they did. And that was where the attitude came from our parents and grandparents.
And those laws have changed.
Absolutely.
So here's a good example. Barry, you've met my father. He's a math teacher.
Great guy.
And he owned his house free and clear. And I'm from Iowa. And he was a math teacher there. And it flooded and flooded and flooded. Mm. He almost lost his entire equity in his home. Okay, so he thought nothing would happen to him. So he took money out, put in a very conservative annuity that's gotten over 9% tax-deferred compounding for over 15 years now. A really good example of a real-life story.
That's awesome.
But he's from the Depression. I think we are, too. I lived 2008.
Yeah.
Maybe it was worse than 1929.
I don't know.
I'm not sure.
Yeah, the only thing that protected us was laws, versus no law back then.
Anyway, Barry, I think you gave me this book, and I don't know how long ago, but it's called Ordinary People, Extraordinary Wealth. It's really a great book and talks about risk management and tax deductions and really becoming your own bank. And I really don't know why I'd pay my house off if I'm borrowing money at 3 1/4, which could be tax deductible. If I can do more than that with less risk.
All right.
Yeah, I think it's a great idea. I've always supported leverage and arbitrage and what have you. We did that in public seminars for years. So, hey, Myles, we're starting to run short on time. Tell our listeners how they can get in touch with you.
You can reach me at 858-735-4323. Can I add one more thing?
Absolutely.
Those that take money out, you can't go buy a new car. Okay.
Why?
Because most people will blow it. You're supposed to invest it in something that gets more than 3%.
Yeah, and not a bunch of shoes either.
Yes.
Don't go spend it all on Jimmy Choo's.
Yeah, it's no, not Jimmy Choo's, because that would be like the same price as a car. So. So that's called financial planning, guys.
Oh, okay.
So, great. Well, Myles, I appreciate you being with us today. Let's carry it on and see if we can't get you back sometime.
You bet. Thank you. Thank you for your time.
Okay. This is Close Up on Sending Business here on KCBQ, streaming live at AM1170theanswer.com. Send us a tweet at CloseUpSD or just find our page on Facebook. You can always email me at barry@closeupsandiego.com. Let me know what you think. I'm your host, Barry Waxler. We'll be right back after a word from my sponsors.